Need to get a deal done in 24 to 48 hours?
Yes.
I mean, seriously? You need to get that? Oh, want the best pricing you can possibly get?
Done.
Really? Do ya?
Yes.
You got to work with Remen Wholesale.
Remen.
Click the banner you see right here on the screen, right down below, and a Remen account executive will get everything done for you at the best price. Why not? Why not?
In the house.
In the house, Remen. Click the banner. Go.
Lenders and realtors alike, listen up. Fannie Mae just had its Q4 earnings call a couple of days ago, and we got the transcripts to prove it. Now, in that, they, being all the brain-trusted Fannie Mae, are going to discuss all of 2020 and what 2021 will hold for all of us, the representative worker bees of the housing and mortgage industry. Now, you probably have a few questions like, what the hell are we gonna do about all the lack of inventory? Or, are rates going to go up, and will that kill my business? Or, are loans gonna loosen or tighten up as the market either keeps climbing as it is or skids off the runway? And these are all really great questions. And who better to answer them, like I said, than the brain trust over at Fannie Mae, the most popular kid on the mortgage block. First, let's see if we can extrapolate any information about the lack of inventory, because that's a big one for all of us. Here we go.
Celeste Mellett Brown, the Executive VP and CFO of Fannie Mae, says there is a risk that loans remaining in forbearance for a longer period of time may decrease the likelihood of a successful outcome. Did we not talk about this yesterday, Brian?
We did.
Now, if a single family loan does not resolve and that remains non-performing for a prolonged period or enters the flex modification, then we are required to purchase it out of trust. And now get this, here's why you have to listen closely. Let's read between the lines here, guys. While these purchasers were $5.4 billion in 2020, we anticipate they could grow significantly in 2021. At year end, $108 billion of single-family UPB, that's underperforming bonds, was in forbearance, including $81 billion was 90-plus days delinquent. We currently estimate that approximately 30% of loans in forbearance may eventually need to be repurchased.
That one should catch everybody off guard because nobody's really talking about this. I don't know if you just heard what she said, but this is a big, big issue for 2021. Fannie Mae believes that the $5 billion in non-performing or unfixable forebore loans, aka foreclosures tomorrow, can and will turn into $30 billion, 6 times higher than the current rate. Further, we learned that Fannie alone has over $108 billion in underperforming forebore loans, meaning the number could be even higher. Lastly, Freddie's portfolio, though smaller, it's huge, though smaller than Fannie's, is going to track right alongside Fannie's. Meaning, if you believe the brain trust at Fannie Mae, relief in more inventory is honestly right around the corner. Either in forced sales, short sales, or foreclosures. Again, this is Fannie Mae who just announced this, not us. Note, as a realtor, you'd serve yourself and your community well by proactively reaching out to your sphere of influence and find out if there's problems on their mortgage front that may be solved with a sale before a short sale. Now, what about those underwriting guidelines, Frank?
The credit quality of single families acquisitions remains strong, helped by the high share of refinance volumes, which typically have better credit profiles. In 2021, acquisition LTVs improved 5 percentage points, 500 basis points to 71%, and FICO scores increased by 11 points to 760.
I find this unfathomable, and frankly, I find it a little bit irresponsible on the part of Fannie Mae and Freddie Mac, because they're supposed to be the government-sponsored enterprises for everybody to get affordable mortgages, not just people whose credit walk on water. Because yikes, the average credit score, did you hear this, of a Fannie Mae loan for 2020 was 760. The average LTV improved on average to 71%. The profile of your borrowers on average is way better than I ever thought it could be. Now, here's what's at issue.
From Hugh R. Frater, Fannie CEO. We are also committed to working with partners across housing to advance opportunity and tackle racial injustice. These commitments go to the heart of our charter and who we are. The gap in minority home ownership is long-standing, and economic turndowns such as 2008 and 2020 only make it harder to overcome. While this is a complex challenge that Fannie Mae cannot address on its own, it is our intention to do all we can to work with our partners in the housing industry to do the same. I sure hope so. They're going to need to do that.
You know, Frank just brought something up that we don't have written for our show, but it's worth pointing out. So Fannie says they they want to help the racial inequality in housing and how they're going to work towards this goal. They have an average credit score of 760 with an LTV of 71%. Now, if you look at the Census Bureau in terms of home ownership rates across race and credit scores across race, I can tell you unequivocally that Fannie Mae has completely and totally failed in its mission of racial equality in housing. Because those numbers do not reflect diversity. They reflect a whole bunch of white people getting a whole bunch of loans, and that's it. In years past, post 2008, the goal, or the primary goal of the GSEs, was to write super clean loans. And they did that, didn't they, Mr. and Mrs. 760 credit score? This year, hopefully, we're going to see a shift in the general charter to be more inclusive and less concerned about the quality of loans. They need to, because what we just read was ridiculous. So why do we say this? Because you simply can't have both. You can't have equality and 760 average credit scores. This earnings report is yet another very clearly defined 2021 objective. What we will focus on as an industry, you will either get in line or you're gonna fall behind. Now finally, Frank, what about interest rates?
Just understand this. The average contract interest rate for 30-year fixed rate mortgages increased to 2.98% from 2.96 last week. Total mortgage application volume fell 5.1% last week from the previous week, according to the Mortgage Bankers Association. Applications to refinance a home loan fell 5% for the week, and mortgage applications to purchase a home fell 6% for the week. Now, we learned from the Fannie Mae earnings report that 68% of Fannie's volume was refinances. It's a sure bet lock that that number is gonna go down. If rates inch up, all your refis jump back on the fence. Purchase applications are down, but we learned from Fannie help is on the way. So it seems to me 2021 is going to be more of a grind than 2020. Hopefully more purchases off of more inventory with more realtors. So my question to all the LOs out there is, are you ready for all this?
Finally, I just didn't want to go over this, but everybody, all the brain trust over at Fannie and Freddie are looking at a recap and release model, not the utility model, which I found kind of surprising. We'll talk more about that later, but it's kind of boring. If you are seeing us for the first time or you've been with us for a long time, you hitting that share button and sharing this helps us get our message out to everybody. But the best thing you can do is just get our app. Just get our app. And how you do it is really quite simple, just like this.
Download the National Real Estate Post mobile app today. Available on Apple Store and Google Play. Just search National Real Estate Post.